Hello everybody. Let us discuss about cost concepts in managerial economics today. Cost concepts are important because the increasing the value of offer of a product to the customer depends on minimizing costs. So every firm tries to minimize costs of production. Managerial decisions are based on value of revenues that they gather, money values, and the money values of costs that they incur. A cost of production is the amount of inputs that we use in the production process, and when that is multiplied by the respective unit prices, we get the cost of production, the money value of cost of production. There are explicit costs, costs which are incurred, which are shown in the books of accounts, like we have raw material payments, we have wages paid, we have utility bills paid, we have insurance premium. All these are reflected in the ledger accounts of the organization concerned. They are examples of explicit costs. These money payments are recorded in the books of accounts. But those are not true in the case of implicit costs. They are costs incurred by the promoter or the entrepreneur. Whoever is taking the initiative incurs costs. He may even incur an opportunity cost. He could have put the money elsewhere and gained some amount from there. But he does not capture that in the books of account. So implicit costs are not there in the books of account, yet we add the in economics we add both explicit and implicit costs. We have two important concepts of fixed costs and variable cost. Fixed costs are those which are incurred to be constant, whatever be the level of output. Employment of fixed factors of production like land, like plant and machinery. These are fixed costs. Or even if you take an easier example, look at IPL. If Chennai Super Kings gives a contract to MS Dhoni for a certain sum of money, it's fixed. The assurance is fixed, the cost incurred is fixed, whatever be the level of output. Whether he scores 500 runs or 50 runs is irrelevant. Similarly, variable costs are costs that change with output. These are largely costs associated with input factors of production, like wages given to contract laborers. Now, these contract laborers are called only depending on how much production is to be increased. Then only you are paying. So, variable costs vary, and that is very important. We have got two important periodicities related to costs: the short run and the long run. The short run is defined as a period in which one factor of production is fixed. In a production function, y is equal to a function of capital and labor. That's a two-factor production function. We assume that capital will remain fixed and labor will vary. That's the short run. But in the long run, all variable and fixed costs, fixed factors vary. So all factors of production are variable in the long run. There will be change even in the fixed capital investment. Like you might set up a new plant and machinery. You might buy a new machinery. All this. So we have a short run concept and we have a long run concept. If you look at the averaging of costs, total cost is equal to total fixed cost plus total variable costs. You can average the total cost by dividing it by the number of units that's produced. Similarly for variable costs and for fixed costs. A marginal cost is the cost of producing the last unit, the cost of creating one more unit. If you are having n production and the n plus 1th is the last unit produced, what's the cost of creating that n plus 1th unit? Similarly, Profits are defined as revenues minus costs. A change in the total revenue arises from a unit change in the output. That is, the n plus 1 brings a marginal revenue. Similarly, n plus 1 incurs a marginal cost. This is the marginal revenue and marginal cost concept. In economics, we believe that to maximize profit, output can be increased up to the level of marginal revenue being equal to marginal costs. If the marginal revenue is more than the marginal cost, then the last unit is giving us more profits. If the marginal revenue is less than the marginal cost, the last unit is becoming expensive. It may not be advisable to continue there. The final concept which I introduced today is incremental costs. This cost refers to the additional cost that a company incurs in undertaking certain actions. If it increases the level of output, it can have a new variety of products. So such investment is incremental costs. A marginal cost refers to the total costs incurred added on by the last unit of in the production line. But incremental cost may be changing the product line, introducing a new product, replacing an obsolete machine or equipment, replacing old modes of production with new methods of production. Now, if the incremental revenues are more than the incremental cost, it is worth going in for that deal. In sum, an incremental cost is a difference in total cost as a result of a change in some activity. These are some of the cost concepts which may be relevant to us. Thank you.